Good morning. I'm Caralee Gurney.
And I am Stacy Revely.
And this is North Texas Networkers, a show about introducing interesting people across the DFW area, sponsored by Craig Schrank with Willow Mortgage. You hear us say that every show. And today we have a surprise for you. The person is real. He's really here today. We're going to talk about mortgages and interest rates. I know we don't normally talk about real estate, but today we are. So welcome, Craig Schrank, CEO of Willow Mortgage.
Thank you. Thank you for having me. Happy Easter.
Thank you. You
yes,
too.
For sure. So yeah, we don't normally do real estate on our show, but I think it's very timely. I know that, people are out there looking and all kinds of things are going on. So we're just glad you're here to talk with us for a little while about it.
I'm ready. I'm ready to talk about it.
You're in the trenches with us, aren't you?
Yeah, we are. We're here. We're here.
How long have you been in the mortgage industry now?
So we started the mortgage company in 1993, and that was December. So I guess now, as of last December, 28 years.
Wow.
So
and for 25 of those years, I think you've been my personal mortgage lender.
Mm-hmm. That's right. That's
Didn't realize you were so new.
That's right. And so young.
And so young.
Yeah.
Yes.
So there's been tons of changes, obviously, over those years. What are some of the things that you really remember from those early times?
I would say starting out, it's just like a lot of industries back then, technology has really changed a lot. When we first started, everything was paper. And, anybody that has gotten a mortgage over the last even couple of years, there's a lot of paperwork involved, but now it's mostly all digital. It's mostly online. And back then there was no internet.
Yeah.
There was
no uploading bank statements.
No uploading. No, it was all fax machines. And even ordering a credit report, now it's instantaneous when you do that. But back then you had a specific machine, like a fax machine specific to credit reports, and it was in its own little section of the workroom, and you'd fax off a request to the credit report company, and 3 or 4 hours later you'd hear the thing going off and the modem chirping and dot matrix printer printing. You go rip it off, and yeah, it was pretty archaic.
Yeah.
Pretty archaic.
I think the real estate world was too. We used to have to go, well, not us, because we weren't in there that long ago, but you used to actually have to go pick up the one key from whatever office you were going to go show their listing.
Yeah.
And then you'd have to take it back.
I remember there was a real estate office right next to our office building where we first started, and they had, I don't know how many agents were in there, but probably just like any normal 80, 90 agents, and there was one computer. And so they all kind of came in and shared the one computer. It's crazy now how it's evolved from what it was.
Can you imagine if we had one computer in our office right now? Just think how many hours a day you spend on that computer.
I remember the pager.
Yes.
I remember, early on having to run out and get some paperwork signed by somebody, and on the way there was a page coming in from somebody, 911. So you had to stop at a 7-Eleven and put a quarter in the machine, make a phone call, get back in your car, head out, and a couple minutes later, another page, 911, pull over. So in one little trip to go pick up some paperwork, you may have to stop 3 or 4 times to answer a pager.
Well, that kind of brings me to right now. Times have changed so much, but the past couple of years have been truly historic in the industry. Tell us a little bit more about that.
Oh, the last 2 years has just been unreal. Anybody that's bought, refinanced, or whatever in the last couple of years, it's just been historic rates. We'd had, back when the market crashed in 2008, we'd had a couple of times cycles back in the mid-2000s where rates got down low. But the last year, 2 years, it's been unbelievably low, where we never thought we would ever get back there again. And just due to the pandemic, it really, really changed the business, and it changed a lot of people's lives because they were able to lock in on a rate that was just unbelievably low, almost zero. It's crazy.
Well, and my personal opinion is that I think that's why we see some of the inventory shortage now, is because people are locked into a really low rate why sell?
Yeah, I agree.
You know?
We talk to people all the time that, in fact, just in the last couple of weeks, there's a lot of people that have had the conversation, well, yeah, we would like to move because we can get a lot more for our house than what we thought we could. But we've got such a good rate. We're thinking, maybe we'll just stay and remodel the house that we have, or, do a home equity loan or a construction loan to build a pool or to add on or to do something instead of moving. So, yeah, I agree.
Yeah.
What % of your business would you say is refinancing right now versus what it used to be?
We've always done almost all of our business has been purchase. To me, the refi business is a byproduct of the purchase business and doing a good job, where, the refis that we do are just past clients that come through and hear rates are low. And, we stay in touch with our clients and let them know what's going on in the industry. So if rates do go down, they'll call and say, hey, is it time or is it worth it to refinance? And so but I would say as a company, we've probably historically been about 70% purchase, 30% refi. That's going to change now because so many people have low rates and don't necessarily want to refinance out of that. So other than home equity, construction, things like that, the majority of the business going forward will be purchase business.
Yeah. Well, and I think it's important to say too, even though rates have gone up, they're still good rates.
Oh, yeah.
And I think it's just a mentality that people have gotten stuck in, like, oh my gosh, they're not low anymore. Well, historically, where are we right now? What does it still look like?
So it's interesting that you said that because, again, conversations as they go, people that maybe pre-qualified to buy or build a home maybe at the end of last year, beginning of this year, and now have decided it's time to move forward, and they call and say, okay, we're ready to go. What's the current rate? And they're almost shocked because, it's been a very short period of time, which is unusual. Although when rates change, they normally go quicker upward than they do downward.
Okay.
And so I would say at the beginning of this year, rates were at about 3.25, and we're about 2 points higher than that. And so it's just a mentality shift. I mean, I was talking to some people at the office last week, and really it's a function of somebody that initial shock that, I've been seeing rates in the 2s, the low 3s for 2.5 years. And now we're, fairly decent number above that. But once it's there for a while, it's there. Mm-hmm. And it's just normal. Yeah. And that's where it was for all of those years before the pandemic. And so we're really, the mortgage rates tend to fluctuate off of the 10-year Treasury. And so the 10-year Treasury back in 18 actually got higher than where we are now. We're at about 2.8% today. We got to about 3.25 back in 2018, and rates are about where they were then. It's just with having 2.5 years of really low rates, people they don't remember that. Mm-hmm. But it's really not that big of a deal, because if you run the numbers and you look at the difference in qualification with 2 points in interest rate, what buyers will do is move down a little bit as far as what they're going to buy. Mm-hmm. And so it's just a mentality shift to understand that we're going to qualify or buy something a little bit less than what we were.
So affordability is still there. Mm-hmm. You just have to settle for a little less than what you planned on doing.
I mean, just for instance, so if you took a $700,000 house and somebody put 20% down, it would take you about, depending on debt load, but it would take you about $10,000 a month in income to qualify for that loan. Okay. To get the same qualification, it would be about a $625,000 house. So it's about $650 a month more with the difference in rate. But the thing you also have to think about is there's a tax advantage too, because with, being able to write off the interest on your tax returns, the 2 points in interest rate, $650 a month, it's about what the cash flow difference is. But with the tax savings, it's about 30% less. So you're only at about $450, $425 in net cost on that same house.
That's a good point to remember. I hadn't thought about
I had never thought about it that way.
tax implications of it.
And things too, people are hesitant, but if you want to buy and you want to own a home, which everybody does, I mean, it's the American dream, right? Sure. So when's the right time to buy? People ask me, when's the right time to buy? It's now. Mm-hmm. If you want the home and it's a good place and it's good for your family, buy the house. Because rates will come back down and you will be able to refinance. So it doesn't really matter. It's a mind shift right now just because it's been so soon since it changed, but buy the house and enjoy it.
How does all of that play in with the inflated pricing and having to pay way over list price?
That's interesting too, because it's almost, there's a couple of different things involved with that. And Stacy, we've talked about this, but there's an inventory shortage. And a lot of the inventory shortage is a result of the pandemic. It's Wall Street. It's people from other states that have cashed out equity on their homes there that are moving to Texas and paying cash and paying higher numbers than what the houses are actually selling for. And so in a lot of cases, it knocks out the people that are trying to buy a house and finance it. And I mean, y'all see it all the time. I mean, how many deals do y'all look at or offers that you make that have just one offer? It's very minimal.
It's rare.
Yeah. And so it's just supply and demand. There's a lot of demand right now, and there's a shortage of supply because of what we were just talking about. People don't necessarily want to move, and whether that's, I'm not confident in my job going forward, I'm not confident that I'm going to be able to afford something else, I'm just going to stay put, or there's a lot of institutional money out there. I mean, there's a lot of cash sitting on the sideline with Wall Street and REITs and institutions that buy up rental property. Some of the, like VRBO. Mm-hmm. VRBO is another thing that over the last year to 2 years, people have been buying second homes, investment properties, and renting them out VRBO. Mm-hmm. And that's just a new industry that's come about just in the last couple of years as a result of COVID.
Right.
So it's interesting.
Are there some creative ways to get around the overlist price, the cash difference that the clients have to come up with?
Well, a lot of people now, sellers and buyers are used to it now, but there's appraisal waivers. Mm-hmm. So a lot of times a seller will say, okay, we'll sell you this house, but if it doesn't appraise, you're going to have to make up the difference. And sometimes that's a challenge for a first-time home buyer or a young couple that may not have a ton of money to make up a shortage. And so that's kept a lot of first-time home buyers on the sidelines. There are programs out there where you can utilize a third party to, step in and kind of be a bridge as a substitute for a cash offer. So, that turns into two transactions, but if you want the house, that's an option.
Yeah, and I think, like you said, it's kind of pushing a lot of the first-time home buyers to the sidelines. Mm-hmm. And, but do you see anything that changes the future of, sellers? I guess my question is there buyer fatigue? Are we seeing that buyers are finally going to just say enough's enough?
Yeah.
And I think I've seen things like that.
We've seen it a lot, because I was talking to somebody last week. They've made, I think, 8 or 9 offers and keep getting outbid. Mm-hmm. And so they're just like, almost to the point where I'm done. I'm sick of this. I don't want to do it anymore. I'm done. Yeah. I'm just going to wait until things slow down. That will happen, but but when is that? Nobody knows.
Sure.
Well, I've noticed there's a shift. I mean, going back a few years with some of the regulation changes and things like that, I understand there's been a shift in what people have to bring to you as far as those who are self-employed, that's changed, maybe loosened a little bit in some of the restrictions they've had.
It has. It got really tight during the pandemic. You know, when we first started in the business, I mean, especially being a financial services industry, there wasn't a whole lot of regulation, and it was almost the wild, wild west. When I first started in the business, I was pretty shocked at the lack of, I guess, oversight, the lack of, and you know, talking to people in the industry and going to some of the industry functions, I couldn't believe some of the conversations that I had, and you know, just some of the stuff that went on. And then when the market crashed in '08, a lot of that was blamed on I mean, everybody's seen The Big Short, the movie, read the book, and a lot of that was a function of mortgage products, crazy derivatives and things that Wall Street created, but a lot of it was just, as you saw in The Big Short, just unscrupulous activity by some of the players out there. And so the market crashed. The government stepped in by way of the CFPB, which is the Consumer Finance Protection Bureau. That's the agency of the government that oversees the mortgage and any financial services company. And it really changed the landscape of the mortgage industry, which is good. We needed it. But on some level, it almost went too far the other way, because as I tell a lot of people now, the business is not necessarily about qualifying, it's about documenting. And we talk to people all the time that may have a ton of money, but they don't necessarily have a job. Well, the government says they qualify the income based on a tax return and what you can show on a tax return. And if you don't have that, you don't qualify. But somebody that has millions of dollars in the bank, they look at me like, well, how in the world do I not qualify? I can pay, 6 times over what the cost of this house is. And so in that case, there are programs for that. I mean, we do a lot of that where it's called portfolio lending, which means the loan is not sold on the secondary market. And when that's the case, we can kind of make up our own rules, and it really, really helps people like that, because it's baffling that some people that have a lot of money and maybe retired that can't qualify for, some people can't even qualify to refinance the home that they've been living in for 15 years.
That's crazy. Well, and that's kind of goes to, a lot of people say, oh, it's just a bubble, there's going to be another crash. And I think, speaking back to the regulations that are in place now, is this a bubble? Is it, or is it?
There will be a correction. There's no doubt in my mind that there will be. But, the difference between right now and when we did have the crash are, like I said, there were a lot of crazy mortgage products out there. There was negative amortization. There was interest only. There were adjustable rates that kicked in, and people really didn't know what they had. And the most important thing about that back then was people did not have to document income, and they didn't have to put any money down.
Wow.
So you could buy a home back then with zero money down and really not even showing what you make. You just, you could write down on the application that, and again, going back to The Big Short, there were school teachers that were owning 6, 7 homes and renting them out, and they said they made $200,000 or $300,000. It's not right, but they approved the loans and did it anyway.
Wow, crazy.
And so when when everything happened back then, values started to come down. The people that bought the homes with no equity in the deal, no cash in the deal, they're looking at it like, I'm out.
Yeah.
If I can go buy a stock and the stock goes down and I can get out for free, that's what people were doing. And, you know, media, online, everybody was almost encouraging people to just give it back, give it back to the bank. And all of that created a huge bubble and a crisis. Whereas now, people are qualifying, they're documenting the income, and most importantly, they have cash into the deal. So you're seeing people pay more than asking price for some of these homes. And so that's, you know, in my opinion, that's overinflating the true value of what those houses are worth. And at some point, you'll have a correction. You always do. And so, but over time, you know, just like anything else, things tend to go upwards, but we've gone upwards pretty quickly. So there will probably be a little bit of a correction, but it won't be a crash.
Well, and that's what I've tried to tell people too, is that, you know, the banks are lending on the value of the house based on the appraisal. They're not necessarily giving the money that's the full sales price. And so I think that's a little stopgap for being protected as well.
Yeah, it is. And, you know, an appraisal is, you know, just protection for a bank to know that you've got a third-party professional that is valuating this home based on, and, you know, then they're also checking to make sure there's no, you know, relationship between buyer and seller and maybe a developer, you know, like some of the third-party, interested party characteristics that could create a problem.
Wouldn't you say that also protects the buyer as well, though? I mean, just keeping them from getting into a deal that wouldn't be prudent for them.
Yeah, it does. But at the end of the day, I mean, what is value? And this happened back when the market crashed. You know, you were having declining values. And so, you know, lenders, loan guideline, you know, underwriting guidelines required, if values were coming down and an appraiser indicated that on the report, there were certain things that you had to do. And I had a number of conversations back then with buyer and seller. You know, they'd be super educated, you know, financial people, and they're like, how can this happen? Because he's willing to pay it, I'm willing to sell it for this price. How does that not work? And that's just
oftentimes we hear that in our market.
Yeah.
That's hey, the value is what someone's willing to pay.
exactly, and that's just economics. But that doesn't necessarily. I mean, that's again going back to the government involvement in the mortgage. You try to standardize something that's not standardizable. And this thing is so huge. You know, Fannie Mae, Freddie Mac, they're the government agencies that buy up all of these loans, at least below $647,000. So they have to standardize underwriting. Otherwise, it's just too much. There's too many variables. So when you standardize things like that, that's where you get into situations that a lot of times just don't make sense conceptually.
So what do you foresee happening over the next year to 2 years?
So the big thing right now is we've got the Federal Reserve, and the Federal Reserve is in charge of, the Federal Reserve of the government is in charge of keeping inflation low, or trying to keep inflation low and employment high. And so we've got good employment now. You know, we lost a ton of jobs back in the pandemic, but we've gained a lot of those back. And so the employment numbers look good, but what we're seeing is a big challenge with inflation. Goods, services, everybody's talking about supply chains. And home builders can't build homes because you can't get appliances, you can't get windows, you can't get
Brick.
It's
one of the things right now.
And when you get it, it costs so much more. I mean, you go to the grocery store and you buy hamburger meat, and it used to be $10 to feed 2 kids, and now it's $25. And so the inflation is a big problem, and that's the one thing that's on the radar of the Federal Reserve. And they just raised short-term interest rates last month. And the thought is, the prediction is that they're going to raise again next month and probably the following month when they meet then. And so last month was only a quarter. The prediction is next month 0.5 point, and then probably 0.5 point. But the challenge for them, it's a bit, I mean, they're in a big predicament because the economy coming out of the pandemic is not super stable. I mean, we were in a big mess for a long time. And so now, if they put on the brakes, the Fed uses short-term interest rates like the gas pedal and brake.
Okay.
Raise rates, put on the brake. Lower rates, step on the gas to spur and stop the economy to help with that stuff. And so as inflation being high like it is, they're trying to raise rates to put on the brakes. And if they do that, hopefully things, the supply and demand again, if the demand goes down and it comes in correlation with supply, then prices should come down and we'll be more in an equilibrium as far as the economy.
Interesting stuff, isn't it? How it all works together and all the different facets of it.
It is.
It's a lot of information.
It is.
As a buyer or a seller, they don't always understand how all of that plays in. A lot of people do, but
Right.
some that just don't understand. And when they hear that rates are going to go up 0.25% or half, does that always correlate to mortgage rates?
No, and it rarely does. And like we were just talking, the Fed has only raised rates 1/4 point, but mortgage rates have gone up 2 points.
Okay.
And so there's the mortgage, the long-term market looks at what down the road, at what they think is going to happen, where the Fed is working on the here and now. And so the Fed uses short-term interest rates, which are overnight lending rates, the rates that they charge banks to borrow money from them overnight. And so, but the mortgage market looks down the road and sees, oh my gosh, if we've got all this inflation and we've got, price instability and all these things, rates shoot up. Because if you're sitting there holding a low interest rate coupon and rates go up, the value of that has just gone down. And so the mortgage market is very fearful of future inflation. And so what's happened is they expect the Federal Reserve to continue to raise rates, which should catch up then to where we are currently. So the expectation is there. The mortgage market has already done it. So I don't necessarily think that if the Fed raises rates several more times that it will correlate to even higher than what we have now. It's just the mortgage market's got to wait and see where we are and what happens, and then it's kind of like a wait and see situation right now, and then what happens down the road is just a function of the economy.
Mm-hmm. Wow. Good stuff. So out of all that we've asked you, what have we maybe should have asked you that we didn't?
Well, where are we supposed to go to get our loans?
We're supposed to go to Willow Mortgage.
That's right.
And call Craig Schrank.
That's right.
Tell us your phone number.
It's 214-668-4606.
And your website?
www.wbm.com.
What's your best advice for buyers right now?
It's what I said earlier. Don't worry about all of the stuff. Just buy. Yeah. Mortgage rates will fluctuate up and down, but the value of a home
Over time.
It's like we were talking the other day. I wish every home that I had that I've sold, I still owned.
Mm-hmm.
Because it's just like the stock market. There's no difference.
I wish I'd bought along the way.
Right.
Yeah.
If you're in a good area, which obviously Dallas-Fort Worth is Texas is a great area. If you're in a great area, it really doesn't matter, because just like buying a stock and having a 401k, over time, the value of that portfolio is going to go up.
Yeah.
And we may have a little blip here and there, but you can't time that.
Right.
You can't, if I buy now, it's going to go down. Maybe, but it's not going to go down a ton.
I don't think we could have timed anything that happened, like what's happened in the past couple of
we
years.
couldn't have predicted
Nobody
that.
would have predicted that.
No.
No futurist spoke about that. So you don't know. And we
No.
all now wish we had, done
Absolutely.
Yeah.
so.
Absolutely.
Good. Well, We appreciate your time and your knowledge.
Yeah, you
quite a
bet.
bit, so-
Anytime. Anytime.
So if you weren't a mortgage lender, what would you be? Water skier? Remember?
I don't know about that. I don't know that my back could handle any more of that. Honestly, it's funny because I interview and talk to a lot of kids that are in high school, college, kind of helping with direction and, whether or not they want to be in my business or just helping them get a feel for what they want to do.
Yeah.
And so when I was in high school and college, I did the same thing. And I just remember all I could figure at the time was my friends' parents that I went and talked to. I went and talked to the ones that lived in the nice houses and drove a nice car. And I remember going to talk to one of my friend's dads downtown. He was an attorney. And it was a high-rise building. I went up there and I put my suit on, and I'm sitting with a view like this, but on the 50-something floor. The clouds are down below. A helicopter flies by, and I'm like, this is really cool.
I want this.
And at the time, there was a show on TV called L.A. Law.
Oh, I remember that, yes.
And so L.A. Law was I loved that show. And that was my first real, I was Perry Mason, and some of those were before my time. So this was my first experience on law. And so when I was in college, that's what I thought I wanted to be, as an attorney. And so, talking to some of my advisors in college, there was, and I think the thought back then was because of LA Law, there were a lot of kids thinking the same thing, and there were just a lot of these attorneys that couldn't find jobs. So I just decided to go ahead and get my finance degree. And they said, hey, if you want to get your law degree later, you can always go back. So I just got my finance degree, and here we are.
Well, and doing a fine job at that.
Thank you.
For sure.
Thank you.
Well, we do want to thank you for having you on the show today.
Oh, you're welcome.
We want to thank you for your support of the show.
Absolutely.
We appreciate that.
Y'all do a great job, and every episode is fun to watch, and you've got some great guests, and y'all do a great job with what you do. So thank you for that.
Thanks.
Thank
Appreciate
you.
that.
You bet.
Well, we'll look forward to next month and who we've got then, which is Michelle Brennan Hall. She's a financial planner, and I think you'll enjoy her as well. I'm Caralee.
I'm Stacy.
And we are your real estate professionals.
Thank you for joining us on North Texas Networkers.
Visit our website, mariposagroupdfw.com. That's MARIPOSA Group DFW.com for more information about the show and other resources. I'm Caralee.
And I'm Stacy.
And we are your real estate professionals.